Okay, just a few quick thoughts from me on these issues. I think we see this as a process of market evolution. We see the first stage as transaction reporting, trade reporting, or whether that's to the market or that's to a regulator or repository. The second stage is the clearing piece of this, and the third is the move or partial move to organized platform trading. You know, we think the goal should be, you know, stronger, more robust market structure. That's obviously the key. If I touch on some of these issues, transaction reporting first, greater transparency is positive for liquid products. It's debatable whether it's positive for illiquid products. We'll come on to that later. The second piece of this is needs to be good data, not just more data. One of the things we learned from MiFID's first iteration of MiFID was we had a lot more data in the equity market. Very unlikely that was better data. And actually it confused people, and it's taken several years to sort of get the genie back in the bottle of that data issue in equities. So I think as we move into the next stage, we need to learn from that and make sure we have a situation where we have good data and quality data that enhances the market. We also need to avoid harming fragile liquidity. People assume that liquidity is a constant, it's there, it's given. It's like you know, an endless supply of liquidity that's just there. If you can harness it, it's not there. And it evaporates very quickly. And it's particularly fragile. And if anything that we've learned in the last 4 or 5 years, we know that liquidity can vanish in a day. So we need to make sure that we don't put rules in place that harm what is already a very fragile situation. We also need to take account of buy-side concerns. You know, a lot of this debate obviously quite often polarizes between the market and the banks and the dealers, but the reality is the buy-side concerns need to be taken into consideration, and they have particular concerns around transaction reporting or data transparency around the liquid product. And so whatever is done here, there has to be careful and phased implementation to get it right. I think clearing is probably the least controversial of the three. There's almost total universal support for the concept of clearing. There's a feeling it de-risks the market. In a sense, what happened before in the OTC market was hundreds of banks were operating as mini clearers. And so by bringing this together into more centralized models with high risk standards, this should be a better risk situation. The reality, however, is that this has to be recognized that this is not costless. This is a cost to the market. This will use up excess collateral. We're talking later about interoperability. But the reality is this is not at zero cost. You do not move to a higher risk standard at zero cost. And so there are costs. The reality is these are costs that are worth bearing to make a much stronger financial model. I think the most controversial, obviously, is execution and trading platforms. And there is this sentiment in the market that Kay referred to, if it's not broken, what are we really trying to fix? You know, is the problem that we didn't have clearing? Is the problem that we didn't have enough quality transparency? Or was it the fact that the market structures for trading were wrong? There's a lot of debate around this. I think the logic of using transaction reporting, good data, to define which products should be cleared and thus which should move to an organized platform is a very solid logic. Again, focusing back on liquidity and what trades, what's active, as opposed to what's inactive, what does not trade. We need to look at both models in the broad sense, in the exchange model on one side, the OTC model on the other side, and look at the best things about both of them. You know, look at the exchange model. Well, it's transparent, and there's rules. And there's good monitoring of the trades that happen on those platforms. Those are all positives. On the OTC market, it's flexible, it's quick, it's low cost. It's proven to be very successful. So to take the attributes of both of those models and combine them, that should be the aim of regulation, as opposed to moving one left to right. And ultimately, the aim of regulation around this should be outcomes focused. What is a better structure for the market? What is better in terms of risk? What's better in terms of the client base? What is fair? These are the things that regulation should look at when they look at trading platforms. And I think ultimately this will be defined, the model should be defined by the client choice and commerciality. How does the client want to execute? Why, give them a choice of how they should execute, and the platforms should facilitate that style of execution. So these are some of the thoughts that we have. There's obviously going to be more questions on this topic later, but that's how I'd just like to say the first few words. Thank you. Thank you.